Walk into a bank and most people imagine a vault. They picture piles of cash stacked, waiting to be handed out as loans. It feels logical. The bank takes your deposits, keeps them safe, and then lends some of that money to someone else. That picture is comforting. It is also wrong. Here is the simple truth. In modern economies, banks do not mainly lend out existing deposits. When a bank makes a loan, it usually creates new money at the same time. That sounds impossible, so let's slow down and make it plain. Money today is mostly not paper notes. It is numbers in bank accounts. Those numbers are called deposits. When you check your balance on your phone, you are looking at deposit money. Now, ask the key question. Where do those deposits come from? Some deposits come from people being paid and then saving. But at the system level, a large share of deposits is created when banks issue loans. A new loan can create a new deposit in one stroke. Imagine you borrow to buy a car. The bank approves a loan for $40,000. What happens next is the moment most people miss. The bank does not typically reach into a vault, count out $40,000 in other people's saved cash, and hand it to you. Instead, the bank credits your account with $40,000. Your balance jumps. That new balance did not come from a neighbor's account being reduced by $40,000. It appeared as a new deposit. At the same time, you now owe the bank $40,000. That is your loan. On your side, it is a debt. On the bank's side, it is an asset because it expects to be paid back with interest. So the bank has created two entries at once. It created an asset for itself, the loan you owe. It created a liability for itself, the deposit it now owes you on demand. That deposit is spendable money. You can use it to pay the car dealer, and when you do, the deposit moves through the banking system. This is why people say banks create money. They create deposit money when they create loans. If this feels like a trick, it helps to think in balance sheets, not in vaults. A bank's balance sheet has two sides. On one side are assets, loans it has made, bonds it holds, and reserves at the central bank. On the other side are liabilities, customer deposits, and the bank's own borrowing. The bank also has capital, which is the cushion that protects depositors if losses occur. When the bank makes a loan, its assets rise because it now holds a loan contract. Its liabilities rise because it now owes the borrower a deposit. The bank has expanded its balance sheet. It did not need to find deposits first. It created a deposit as part of the Lending Act. This is the core mechanism. Everything else is detail. So why doesn't a bank create infinite money and get rich? Because creating a deposit is easy. Keeping the bank safe while doing it is hard. Banks face constraints. First, a bank must believe the borrower can repay. If too many borrowers fail, the bank takes losses. Losses hit the bank's capital. If capital is damaged enough, regulators can shut the bank down. So the bank cannot simply create loans to anyone. It must manage credit risk. Second, a bank must manage liquidity. Liquidity means it must be able to meet withdrawals and payments when customers demand them. You may keep your money in the bank, but you can move it at any time. If many customers move money out quickly, the bank needs cash-like resources. This is where central bank reserves matter. Reserves are not the same as deposits. Deposits are the money we use in daily life. Reserves are a special type of money that only banks and the central bank use to settle payments between banks. When you pay someone at another bank, your bank must send reserves to the other bank through the central bank's payment system. So a bank that expands lending also tends to face more payment flows. If its customers pay others, reserves can leave the bank. Does that mean the bank needs reserves before it can lend? In practice, banks lend first and then ensure they have enough reserves to settle. If they come up short, they can borrow reserves from other banks or borrow from the central bank, often at a policy rate. So reserves constrain banks, but not in the naive vault money way. Reserves are about settlement and stability, not about where the deposit came from. Third, banks face regulation. Regulators require banks to hold a minimum level of capital relative to risk. This is a major break on unlimited lending. Loans are risky assets. The riskier the loan, the more capital the bank must hold. Capital is expensive, so this limits growth. Fourth, banks face demand. People and businesses borrow when they have reasons: homes, equipment, inventory, expansion, emergencies. When confidence is low, demand for credit falls. In recessions, even if banks are willing, borrowers may be cautious. So banks create money, but they do it inside a box. The box is risk, liquidity, regulation, and demand. Now let's address the next misunderstanding. If banks create money, is it fake? It is real in the only way money is real. It works because everyone accepts it. Your deposit is a promise from your bank to pay you on demand. It is backed by the bank's assets, its capital, and the central bank's support for the system. It is also supported by deposit insurance in many countries, which increases trust. Money is not only paper. Money is trust in a promise. Here is another key point that makes the system click. Banks create money when they lend, and they destroy money when loans are repaid. Suppose you repay $1,000 of your car loan. The bank reduces your deposit by $1,000 when you make the payment. At the same time, it reduces the loan balance by $1,000. The deposit money disappears from circulation. The bank's balance sheet shrinks. This is why credit booms can create a lot of money, and credit contractions can destroy a lot of money. It also explains why financial crises can feel like money vanishing. When loans default, banks stop lending. When loans are repaid faster than new loans are made, deposits shrink. Spending slows. The economy weakens. That is a credit-driven cycle. So what about the classic money multiplier story that many people learned, where banks keep some reserves and lend the rest? That story describes an older way of teaching, and it can mislead. In reality, modern banking systems are driven more by lending decisions and capital constraints than by a simple reserve multiplier. Central banks supply reserves as needed to keep payment systems working and interest rates near their targets. If you remember one line, make it this: loans create deposits and reserves support settlement. Now, let's follow the money through one real example. You borrow $200,000 to buy a house. The bank credits your account with $200,000. You pay the seller. The seller deposits that money at their bank. Now, the seller's bank has a new deposit liability to the seller. Your bank must transfer reserves to the seller's bank to settle the payment. From the public's view, the money moved from you to the seller. From the banking system's view, deposits shifted from one bank to another, and reserves moved between banks. Notice what did not happen. The system did not need someone else to reduce their deposits by $200,000 for you to receive yours. The loan created the deposit. The settlement moved reserves. This is why housing booms can expand money supply quickly. Mortgages are large. When mortgage lending surges, deposits surge. People feel richer. Spending grows, construction rises, prices can inflate. Later, if lending slows, the opposite happens. Now we can answer a big question. If banks create money, does that automatically cause inflation? Not automatically. Inflation is about prices rising across the economy. Banks can create deposits, but prices rise only if spending demand outpaces the economy's ability to produce goods and services. If new bank money goes into productive investment, supply can rise too. If new bank money goes into bidding up existing assets, like housing, you may get asset inflation instead of consumer inflation. If people are cautious and save, deposits rise, but spending may not. This is why you can have fast credit growth in one sector and still have stable consumer prices for a while. So what role does the central bank play in all this? Think of the central bank as the manager of the system's temperature. It cannot control every loan, but it can influence the conditions under which lending happens. The central bank sets or targets short-term interest rates. Higher rates make borrowing more expensive and can cool credit growth. Lower rates make borrowing cheaper and can encourage lending. The central bank also acts as lender of last resort, providing reserves to banks in stress so the payment system does not collapse. During crises, central banks may lend aggressively or buy assets to prevent a financial freeze. That is not because they love banks. It is because a collapse in deposits and credit can drag the entire economy down. This brings us to the most practical part: what this system means for ordinary people. When you deposit money in a bank, you are not placing cash into a box with your name on it. You are lending to the bank. The bank owes you. Your deposit is the bank's liability. When the bank lends to someone else, it can create new deposits. Those deposits become spending power. So in a credit boom, money feels plentiful. In a credit crunch, money feels scarce. That is why interest rates matter so much. Rates affect how quickly banks want to expand lending and how willing borrowers are to take on debt. Rates also affect asset prices because many assets are valued by discounting future cash flows, and it is why trust matters. Banking is built on confidence that deposits will be honored. If confidence breaks, people rush to convert deposits into cash or move them to safer banks. That is a bank run. Bank runs are not caused by bad feelings. They are caused by the mismatch at the heart of banking. Banks fund long-term loans with short-term deposits. The system can work for decades because not everyone withdraws at once. When fear spreads, that assumption breaks. That is why modern societies build stabilizers, deposit insurance, central bank backstops, bank regulation, and capital buffers. These are not decorations. They are the supports that make deposit money credible. Now, one last point that completes the picture. Banks create most money, but they do not create net financial wealth for the private sector the way a government can. A bank-created deposit comes with a bank-created debt. Your deposit is someone else's loan. The private sector gains spending power, but it also gains obligations. When a government spends by issuing currency or by deficit spending, supported by its central bank, it can add net financial assets to the private sector. That's a different mechanism. Both matter, but they are not the same. So the simple truth is not a conspiracy. It is an accounting reality. Money is not mostly printed, it is mostly written. Banks write money into existence when they lend. They erase it when loans are repaid. The central bank sets the conditions and keeps the plumbing working. The economy rises and falls with the flow of credit, confidence, and repayment. If you understand that, you understand why booms feel like easy money and crashes feel like money disappearing. The vault story is easy to imagine. The balance sheet story is what actually runs the world.